Good morning. It is Monday, February 19th, 2024. So this is President's Day or Washington's birthday in the US. It's also a holiday called Family Day in Canada. Europe is still open, as far as I know. But North America is having a bit of a holiday Monday here on February 19th, 2024. So we're going to start with some macro this week and then delve into some precious metals analysis, discuss some miners, junior mining chart, some of the gold miner earnings from last week, and then I'm going to invite you to subscribe to one of my premium services. So this is Rob Sin at CEO Technician on X, at Goldfinger on CEO.ca, and at Goldfinger Capital on YouTube. And we begin today with commercial real estate concerns in Europe. Definitely some talk starting to become more prevalent about German, Swiss banks holding some really underwater CRE exposure that is becoming increasingly problematic. I chose this piece from Reuters because this is fairly current, end of last week. European banks and their $1.5 trillion commercial property headache. And really, the situation is summarized by one quote in here, which basically says that the industry experts say prices have further to fall. There is currently not much price transparency, with owners unwilling to sell at reduced prices and asset managers slow to revalue their holdings. So this is classic financial crisis, slow motion prelude to a financial crisis. Recall, same thing happened with the Japanese banks after their market bubble popped in the late 80s, early 90s. They were slow to revalue. They didn't want to sell, and they made up their accounting for more than a decade, right? US, same thing, subprime crisis, 2005, 2006, 2007. Slow to revalue, slow to mark down their books in 2006. And then Bear Stearns eventually happens, and then Lehman Brothers happens, and the whole house of cards comes crumbling down. So, if this was 2008, 1.5 trillion is a very big amount of money. It's enough to topple everything. But in 2024, I mean, just think about what the central banks like the ECB and the Fed have on their balance sheets. They could paper this over again with some new stealth QE nonsense like they did last March with the regional banking crisis and the UBS thing, and Credit Suisse, right? So the Swiss banking sort of panic that happened last March and the regional banking panic that happened in the US, right? So I expect we'll hear more about this, which this seems like it's early days, just starting to hit some headlines. Some people are starting to talk about this. I didn't recall many people talking about CRE crisis at the end of 2023. Definitely, there's some pain in this area, but nobody knows exactly how big the exposure is. So it sounds like we're going to start to find out more about this. And Germany is sort of the cutting edge of this. The German banks, there's quite a few of them who seem to have significant exposure to both European and US commercial real estate. So that's interesting because toss that in with China's property bubble bursting, and we've got real estate debt headaches across the world, essentially, right? And what is the solution that central banks and policymakers have found for these sorts of problems in the last couple of decades? Well, basically every single time it is more stimulus and more emergency programs to try and backstop the system, which essentially always results in monetary policy easing and quote unquote money printing. So in last week's video, we discussed a lot of things. We discussed China quite a bit and how they're having some serious problems over there, and that is weighing on commodities. It's interesting, China was closed last week for the Chinese Lunar New Year. It's now the year of the dragon. So China will be coming back from its holiday this week. And I think that bodes well for precious metals and maybe even for the miners. I also discussed how dreadful the performance in the gold miners was up until last week. Well, we got a lot of earnings reports from them last week, and I'll talk more about that in a bit. But what was one of my sort of pound the table topics last week? Well, it was palladium and the capitulation level sentiment that we had in palladium walking into last week. We'll look at what palladium did. It rose $100 an ounce last week. So that's a positive sign, I believe, for precious metals and commodities more broadly, that palladium finally appears to have found support near 860 an ounce, pop back above 950, and now we have to see if it will be able to vault itself back above 1,000 in the next couple of weeks. But I would put this as a feather in the cap of metals and precious metals bulls, that basically this worst performing metal that has been so hated in the last several months finally saw some short covering and some actually new long buying. Futures pretty much flat. Gold is trading a little bit above 2030. You can see I've drawn some lines here on my hourly chart. 2000, obviously, big round number support level. Gold trapped some bears last week on Valentine's Day under 2000. That was Wednesday, and then proceeded to find support and rally back up. Now we'll have to see if gold can get back above 2035 and then eventually back above 2050 this week to really put in place a firm bottom that was an important low made last Wednesday. Another topic I discussed last week was the Super Bowl. And actually, the three ideas I had on the video was 2 for 3. The only one that really didn't work was George Kittle. Some reason the 49ers decided not to use that guy at all in the Super Bowl, which seems like a mistake now. But the Chiefs did win. I took the Chiefs in last week's video, and it was a bevy of field goals on both teams. 2 field goals above 50 yards, including a record 57-yarder from the Chiefs, a Super Bowl record 57-yarder. So hopefully you managed to make a little bit of change off of last week's video. So enough of last week, and let's move into this week. So silver, commitment of traders data. I've been kind of not paying a lot of attention to silver the last couple months just because I feel like it was working on putting in place a bottom. I feel like it has found very firm support near $22 an ounce again. And it's starting at the end of last week, it's starting to move back up. Based upon the CFTC commitment of traders data, the backdrop for silver is very constructive heading into this week. There's no real negatives for silver right here. And I could see silver get back above $24 by the end of the month. And then we'll have to see what happens in March. And, silver has some not so favorable seasonality, some seasonal tendencies in March. But, if there really is a commercial real estate crisis in Europe and the US, and and China has to pump in more stimulus into its economy, and it does get into the trillions, as we discussed last week, then all bets are off in terms of seasonality. It could be like last March, where we see a very strong rally in precious metals towards the end of the month, right? But we'll see. There's a lot that we simply cannot know at this point in time. But the backdrop with managed money, so trend followers like CTAs, hedge funds, they're net short silver again. So you can see that in this blue line that's been moving lower since last November. They are net short again, and it's actually a net notional short position of a little more than $1 billion US dollars. Not as big, not like the biggest of all time or anything. I mean, we've seen this get up to a few billion, previously, but not very often does managed money get net short to this extent in silver. It might happen once a year or something, and it usually closely coincides with a tradable low. It's just a sign that the downside trend is getting a bit overextended, and maybe they're pushing their luck a little bit too much on the short side. Now, the thing is that this data is of last Tuesday's close, so a lot can happen in a couple of trading days in future. So it'll be interesting to see this next week's data. But simply stated, the backdrop is very constructive for silver. Investor sentiment is not euphoric. It's not even close to euphoric. I think investors, traders are frankly quite bored with silver. That's usually the sort of backdrop from which a short covering or a short squeeze rally happens. There's that old saying, never short a dull market. Well, silver has been a pretty dull market in January and February so far this year. The broader stock market looks increasingly vulnerable to a correction. I mean, this is the QQQ daily chart. I mean, yes, we're basically at very close to all-time highs, but there are some early signs of weakness starting to form. A lot of people will point to this bearish divergence in the relative strength index, where this high at the end of last year, the relative strength was well above 70, strong momentum. And then the January high was on slightly weaker momentum. The RSI was a little bit lower. And then the February new marginal all-time high was yet even weaker. It barely hit 70 on the daily RSI 14, and now it's starting to turn down. Okay, so it's still very early, but just based upon the ridiculous levels of call option activity and ODT option activity that's driving this market day to day, it just seems to me that we're in an increasingly unstable environment, right? And so far, the market has been able to shrug off whatever's going on in the Middle East or Ukraine, even China. The U.S. stock market has essentially been bulletproof, at least among like the NASDAQ 100 components like NVIDIA. But I'm seeing Jeff Bezos of Amazon selling more than $6 billion of stock in a single week, and just continuing to see complacency rise even further among market participants. Nobody thinks the US market can go down at this point, really. Even people who have been bearish for much of the last year are just fatigued on the short side. Like, nobody has any real gumption to bet that this thing is about to roll over. I feel like we could be in for a bit of a market correction over the next 2 to 3 weeks. This is not something that I'm willing to bet a huge amount on, but I'm definitely willing to sort of dabble with intraday shorts and maybe some like weekly put option plays. Just very tight risk management, fading a trend that is this powerful. But the fact is, underneath the surface of the U.S. stock market, the market breadth continues to deteriorate. Small caps are nowhere near the strength level of NASDAQ 100 components, like, NVIDIA, Amazon, Microsoft, et cetera, right? There's non-confirmation of the recent all-time high in the IWM. And, these non-confirmations happen all the time in bull markets, right? It's not a screaming, flashing red light, short everything. No, but eventually it starts to matter that there's just fewer and fewer stocks making up the advance. And once one of the major leaders, like let's say NVIDIA, starts to get hit 5% a day, then suddenly it's game over for the whole thing. Okay, the dominoes start to fall apart. Tesla's already been shot down big time in January. It rebounded a little bit last week with China closed. It'll be interesting to see how Tesla trades when China reopens. Obviously, you can see Shanghai went out prior to the Lunar New Year with a 3-day rally. It'll be interesting to see how it reopens and how it trades this week, because clearly there has been a market panic in China so far in 2024. Will it continue or have things stabilize? My guess is that they have not fully stabilized, and the Chinese government will need to do more to stabilize the situation. So turning to gold, the fairest metal of them all, the one that I love the most. A little bounce last week. So we did get downside early in the week, tested that 2000 level. Bears tried their best with the Chinese on holiday for a week. Bears tried their best to knock it back under 2000, and they couldn't. They couldn't. We had some bullish economic data last week. We had the market pushing back expectations for the timing of rate cuts, and China was closed. And look at what happened. Support held at 2000 and moved back up above 2020. And again, we're trading above 2030 this morning. So the context is key. Gold held very important support and found buyers during a week when it was a little bit vulnerable. Gold open interest. So notice that the open interest, which is bottom here of this chart, the green, it's been falling off a cliff so far in 2024. This is very, very low open interest, almost down to 400,000 contracts. I've almost never seen it this low in gold futures, right? Large and small speculators continue to trim their net length. So this is all very supportive. The fact that gold is holding up above $2,025 an ounce, while futures open interest has plunged. There's no real speculative aspect in the gold market today. There's no hot money. And again, rate cut expectations have dropped considerably in the last couple of weeks. You can see the black bar is what was priced in terms of cuts at the end of January. Everybody was thinking May was pretty much certainty. June, definite certainty. Well, now it's pushed towards June, and June is not even a certainty. June is like a probability, maybe 60-40, 70-30, but it's definitely not a lock, right? And then the subsequent rate cut odds have also dropped. So we're looking at some point at the beginning of the year, the market was thinking 5 to 6 rate cuts in 2024. Well, we're looking 3, maybe 4 if the data really starts to weaken. So the Fed's guidance, the Fed's own guidance, calling for 3 rate cuts, that seems to be what is likely at this point. And meanwhile, North American investors, continue to sell gold ETFs. Okay, so this is very interesting that North American investors who trade the GLD or the IAU or what have you continue to cash in and dump their gold. So gold is holding up against all this negativity, very weak sentiment on the yellow metal, and no speculative activity. People are speculating in NVIDIA. They're speculating in ODTE daily expiry options on US stocks. They are not speculating in precious metals. There's no silver squeeze or anything close to it going on. I cannot recall the last time I saw a precious metals meme on social media, right? Think back to early 2021. Everybody was making memes about silver squeeze, silver bulls, what have you, the dog holding up the silver bar like it was the Pope. And no, we got none of that. We got none of that. And nobody's even posting any pics of their silver and gold stash, right? That's the time you want to pay attention. That's the time you want to be interested, because we have a very low level of interest in gold and silver, yet they started to move up last week, and gold held a very key support level. Silver held a very key support level at $22. And look at silver is up about 4% for the week. So it's one of its best weeks, certainly its best week of 2024, but one of its best weeks of the last several months. And you see that volume pour in there. So still, the weekly chart, it's a sloppy range-bound mess for the last year. I'm not making a big deal of it, but support held. And if the range-bound oscillation continues, well, the upper end of the range-bound oscillation is $26 an ounce. We just bounced off of 22. So the 22 to 26 range continues to be in play until it isn't. Again, China was closed last week, and copper rallied on Thursday and Friday. So copper got all the way down under 370 a pound and turned back sharply higher on Thursday and Friday, closing at about 384 a pound. So copper's best week in quite a while, up about almost 5% for the week. And again, that's an impressive performance considering that China was closed. So now let's see what happens when China reopens. And again, kind of like what I said about the silver chart, I could say the same thing for copper. It's still a range-bound mess. There's no clear trend here. You can see the moving averages are flat. And here's the silver seasonality. So this is something we want to keep in mind. February is usually a pretty good month for silver. It's also not a bad month for gold, but March tends to be quite mixed. And more often than not, it is actually negative in the last 20 years. So that's something to be aware of. The seasonality gets a bit bumpy in a couple of weeks, but then turns favorable again in April. Obviously, the sweet spot generally for precious metals is sort of the summer, the end of summer into Labor Day rally. Okay, so let's move on to uranium. Cameco chart, CCJ, finding support near $41 a share. But you can see this is a pretty prominent double top up here in CCJ near $51 a share. And URA, the uranium ETF, testing its 50-day moving average. Very important, support level as well. But this is really important because both of these charts and many of the stocks in the sector have been hit pretty darn hard here in February, and they are at really critical support levels. So we really want to see how Cameco, how the URA trades this week. If this is a bull market, if this continues to be a bull market, they should find support right here and start to turn up again. I think 41 is really a key level in Cameco, and it also is almost exactly 20% from this double top high of a few weeks ago, just above $51 a share. And I sort of view this sector as maybe a leading sector for the commodities overall. So if the risk appetite is going to return, we want to see uranium find a bid and start to turn back up again. So let's move on here, because I do want to talk about the gold miners, and I do want to talk about my Substack. So this is my Substack, Goldfinger Capital. It's pretty cheap to subscribe. It's $8 a month, right? And on here, I make 3-4 blog posts a week. It could be about junior miners. It could be about trading psychology. It could be about the Fed. It could be about a lot of different things. So last week I published 3 articles dissecting a junior mining news release, Condor resources. So this one is a paid article. I'm not just giving this one away. You gotta subscribe. $8, big ask. And I talk about how to read a news release from a junior mining company and how to sort of read between the lines and really put it into context. And then another paid post, you gotta pay $8. Frank Zustra takes 11.2% stake in Libero Copper. And so I discuss the news that came out at the end of last week and some important context about this company and why this very well-known investor might be doing this, sort of what his plans could be. Okay, so this is my Substack, and also I have written quite a bit about Hercules Silver. Some of it has been made free to the public, and some of it is still behind a paywall. So turning to the Hercules Silver chart, I'm not talking about the company really, because there's nothing new um, in the last couple of weeks, really. They did add some technical advisors, some PhD guys who are experts in porphyries. I think that's very positive. I've read a couple of people saying it was negative because it's a sign that they don't know where to target. Could you be more idiotic? I mean, could you be more idiotic and just a biased basher to say something as dumb as that? Okay. They're adding very sharp minds who have a lot of expertise, a lot of experience in these types of porphyry systems so that they target as effectively as possible, because drilling 800-meter or 1,000-meter holes, you're basically, every hole is basically a Lamborghini. So aren't you going to spend your shareholders' money as wisely and effectively as possible instead of just blowing away several Lamborghinis with poor targeting? Of course, you're going to bring the biggest brains with the most experience to do this thing right in 2024. 20,000-meter drill program is coming in, I don't know, 2 to 3 months. It's going to start. I'm not sure when, but probably definitely by the end of May. And, that's going to be probably a $10 million spend on drilling. So they want to do it right. And obviously Barrick has made a big investment here too, and they want to also do it right. Okay. They're very much aligned with shareholders of Hercules, and they want to see this company drill out a big discovery. So anyway, enough of the FUD and nonsense that's put out there by various people. The chart. So let's just talk facts on the chart. Since that January 2nd news that disappointed the market, the expectations for the follow-up holes to hole 2305, the deeper copper porphyry holes at Hercules, the expectations were just simply too high. And when the results were announced, there was disappointment. We've been dealing with that disappointment, sort of an ebb and flow of investor sentiment for the last 6-7 weeks. And you can see by the average true range that the range has basically dropped in half here in 2024. So volatility is declining, the range is narrowing. It seems like $1 is still a key resistance level. It also seems like 80 cents is a bit of a support level. We just tested that level at the end of last week and just bounced up off of it a little bit. You can see the Bollinger bands are narrowing. I, based upon my experience of looking at junior mining charts and how this is playing out, the range narrowing, contraction in volatility, declining volume, this is setting up for a pretty big move, let's say in the next few weeks, maybe by the first week of March. I don't know what's happening the first week of March. I think there's a big global mining conference in Toronto. This is just my intuition, my read of this chart. We're going to probably see a pretty big move. That could be on the order of 20 to 30%. It might be more, and it could be higher or lower. Okay, I'm going to throw out both possibilities. It could be down to the 200-day moving average. It could be up above $1 and into this gap that's still open. So remember, I've talked about this island top many times. Well, it's still present because we haven't really gotten that daily close above $1 a share to invalidate it. Okay. So $1 has proven to be a resistance level. Now it's also lining up with the 50-day moving average. So it's an even more important level. And obviously there is some pretty big support down between 75 and 80 cents. Okay. So that's my take on Hercules. Like when you see these Bollinger Bands start to really narrow, realize volatility really starts to drop off, volume dries up, you're usually getting close to a big move. And maybe we'll get some clues in the next couple of weeks. I got no idea. But yes, I am very much long Hercules Silver, BIG on the TSX venture. And then let's talk about actionable trade subs. So basically the last topic, gold miner earnings, actionable trade setups from last week. So a lot of gold miners did report earnings last week. Overall, the earnings reports were better than feared. I wouldn't say they were blockbuster or knock it out of the park by any stretch, but the market was bracing for really bad news from Agnico, from Kinross, from IAMGOLD, from a number of them. We're getting Newmont this coming week. We'll see what that is because Newmont's been trading really poorly. So the market is definitely bracing for something bad from them. But Kinross actually delivered on its 2023 guidance and it issued a strong, pretty good 2024 outlook for 2.1 million ounces of gold equivalent production for the full year. I will say that there's still a little bit of a cost creep higher. You can see the full year gold all-in sustaining cost was 1316. Q4 was 1353, so that's a little bit above the average for the year. So there is still like this little cost creep higher, but the rate of ascent is definitely slowing. So like on the call, they basically said they saw 5% inflation across their entire business in 2023, and their guidance for 2024 is basically 4% inflation across their entire business. So while the Fed says it's targeting 2% inflation, while we get some reports that say it's real inflation today is around 3%. Well, this is a company that has operations globally, including in North America, and they're telling us they're prepared for 4% full year inflation in 2024. And I think honestly, a gold mining company is probably giving us a more accurate, glimpse into actual inflation than almost any other company, especially a global one that has operations throughout the world, including in high cost jurisdictions like the US and Canada, right? So Kinross basically telling us that the Fed is still definitely not at its 2% target. Overall, I thought the earnings from Kinross were very good. And the update from Great Bear, which is their tier one asset in the pipeline, I thought that the update from Great Bear was fantastic. They're now above 6 million ounces in all categories at Great Bear, and it continues to grow. So, in all likelihood, this thing, when it's all said and done, is going to probably be at least 10 million ounces. It could definitely be more. And the average grade of their inferred went up to 4.5 grams per ton. So there was a notable increase, and they reported some really nice deeper intercepts. I mean, this is 900 meters, this is 700 meters, but still, it's not often I see a company drill 3.5 meters of almost 400 grams per ton gold. That's not gold equivalent. That is gold. That is 12 ounces per ton of gold. So you're looking at $25,000 a ton rock over 3.5 meters. This is a very rare intercept. And yeah, it's at 900 meters vertical depth. So this is not going to be mined for, 20 years probably, but still shows the richness of the system. This is an extremely pregnant gold system at Great Bear. And it continues to get better the more they drill it, the more they work it. So overall, I thought the earnings report, the conference call from Great Bear was really quite good. Now, the market response, it responded great, like initially Thursday morning, and I had bought Kinross on Tuesday heading into the earnings print, and I took profits on that big spike up. I think it was up almost 7% at one point. So, anytime I see a gold miner with a 6-7 billion market cap up 7% in an hour, probably going to hit the sell button unless there's something really extraordinary going on. As it turned out, that was the right move. The market might still just not love the fact that costs continue to creep higher here. It's looking like the all-in sustaining cost is getting up to that $1,400 level, which seems to now be quite standard in the gold mining industry. Well, if gold is 2,000, the all-in sustaining cost is 1,400. You still got a 30% margin there, a $600 an ounce profit margin, but clearly the sector is still out of favor. Kinross tried to rally there and it could not really hold it, but it did hold that $5 support level. And I want to show you, this is my Trading Lab private channel where I post my trades on single stocks and futures. It's usually S&P futures, but I also trade gold futures. I trade big cap, large cap, or mid-tier gold miners. As you can see, IAG and KGC are here. And this is just a snapshot. This is from basically the last 10 days of my real-time trade alerts. Well, not too bad. I think I got one losing trade on this whole sheet. And I have a track record that goes back more than 6 years on this channel. And I'll just say quite bluntly, the track record is extremely positive. If you're interested in learning more about this, I'm accepting 5 new members to the Trading Lab, where you get a daily email and you get access to my real-time trade alerts. You get to also ask me questions about my trade setups and my trading strategy. I'm accepting 5 new members to this. If you're interested, this is a paid service. Send me an email to ceotechnician@gmail.com or message me privately on ceo.ca@Goldfinger. I will say that this is a very special opportunity. I'm only accepting 5 people. And if you're not happy with the value that you receive after 30 days, I will give you a full refund. So this is a one time a year sort of thing. First 5 people that are seriously interested will get this opportunity. The next gold miner that I traded last week, and I continue to hold this one, IAG, IAMGOLD. This has been a great short-term swing trading vehicle in the last few months. Just look at this ping pong range this stock has been in for much of the last year. Buy low, sell high, rinse and repeat, do it again has worked very well. And I've made a number of profitable long trades on IAG in the last year. They reported earnings last week, and while the EPS and revenues beat estimates, the real, you can see they came in at the high end of their range, 465,000 ounces of production full year versus a guidance range of 410,000 to 470,000 ounces. So the company is delivering, but really it was the update on Côté Gold that I think everybody was focused on. At the end of 2023, Côté Gold was estimated to be 98% complete. So it is basically complete now. And production at Côté Gold on a 100% basis is expected to be between 220,000 and 290,000 ounces for the full year. But perhaps most importantly, initial gold production by the end of March and commercial production is expected to be achieved in the third quarter. The company expects Côté Gold operations to exit the year 2024 at a throughput rate of approximately 90% of nameplate. So this is what the market wanted to hear from IAMGOLD. This is very important. The fact that Côté is on time now and it is expected to basically end 2024 at nearly 100% of nameplate commercial production. So let's see if they can deliver on what they're saying here last week. Also, they gave guidance, all-in sustaining cost between 11 and 1200 an ounce. So that, let's say the midpoint of that range, 1150. This is a good gold mining operation. Let's see if they can deliver on this guidance. The market liked it. IAG was up Wednesday, Thursday, Friday. It's trying to break free from this range. I think that after spending so much time building energy, ping-ponging between 220 and 260 or 270, this stock is finally poised to break out above 270 in the next month. Maybe it will require confirmation of initial production at Côté Lake to actually break out of the range, but I feel confident it's coming, and I think that the volume and price action we saw at the end of last week is confirmation that some other bigger money managers do agree with me. So I continue to like IAG. And again, if you are interested in subscribing to this premium trade alert service, send me an email or private message me at Goldfinger on CEO.ca. I'm taking 5 new members in the next couple of weeks. I do not post alerts on junior miners here, on microcaps. The liquidity is just an issue. It's just not good. So we're focused on large caps and futures. So S&P futures, gold futures, large cap stocks like a Cameco, like a Newmont, like an Albemarle. Yeah. But again, send me an email and feel free to ask me questions. So that is a wrap for this week's video. Enjoy your President's Day, your family day if you're in Canada, and I hope you have a powerful trading week.